Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap, and we have some green on the screen. The S&P 500 climbed alongside the Nasdaq Composite for back-to-back wins as we saw Wall Street rebounding from a losing week and leading the charge, chip makers. The broad market index was up 0.6%, closing at 5,975 for the S&P 500. The Nasdaq Composite added 1.2% to 19,865. The Dow Jones Industrial Average was the laggard, losing 25 points or 0.1% down to close at 42,707. So looking at those chip stocks, we had Nvidia jumping 3.4%, closing at a record high after the stock posted 3 straight days of gains. And we also have Foxconn recording or announcing record fourth quarter revenue. So that provided a pretty good backdrop for other chip stocks to also do well. And we saw the Van Eck Semiconductor ETF jumping more than 3%. For more insights on what's happening in the markets, we've got Rick Bensignor. He is the president for InTheKnowTrader.com. Rick, thanks for joining us on the show today.
Good morning, Ryan. How are you? And Happy New Year.
Happy New Year to you, Rick. I'm doing well. I hope also the same for you. Let's take a look at how well markets are doing. So let's start with how, I suppose, we are off to a good start so far after a bit of profit taking in the last few trading sessions.
Yeah, so, we finished the year with some weakness, nothing really material, but, a few percent off the high. And today's kind of was an interesting day in New York because you opened well higher, you rallied, but you actually closed lower than the opening price and very mid-range. So S&P was something like, 45 points off the high when we closed today. So you may be closer to even a near-term little top again. I've been on your show fairly consistently about once a month or so, and for probably since last summer, I was calling for the S&P to top at 6,100, the spiders at 609, and that so far has been the high, but I'm looking for a deeper pullback than we've seen so far, which only got spiders to about 580. I think there's still some more potential weakness here. And if you take out last week's low, I think you open the door for another kind of few percent lower. And ultimately, I can make the case that the market potentially has a pullback in spider terms anywhere from, I'd say, 570 down to maybe 540. So, still some room to go from the 585-ish or so that we are now.
Yes.
595 that we are now.
Some room to go indeed. And I guess this is typically the time we look ahead to the rest of the year to talk about how far more we can go. If you look at the past 2 years, the index has climbed some 53%. That marks one of its strongest 2-year performances since the late 1990s. So if we are watching or waiting for the pullback, where are you going towards or repositioning for 2025?
So, look, if we get the pullback I'm looking for, I will put money to work. I've raised cash over the last few months, some of it perfectly near the high, but some of it too early. But I do have cash available, and I would be looking to put it to work somewhere potentially beneath the July highs. I think you may need one kind of down move underneath there to really scare people, get some more of the last few months buyers becoming much more fearful of kind of late to the game buying to wash out some of those weak-handed longs before I put things back to work. So let's just say the 200-day moving average now on spiders is about 555. That's going to move up each day minimally, but it's upward sloped and has been for quite some time. So, somewhere around there down to maybe the mid-540s in spider terms is where I'd probably put capital back to work. And I think we probably have one more rally left to new all-time highs that potentially takes the Dow to something in the neighborhood of 47,400. And then I think, honestly, Ryan, and that probably is later in 2025. I think from that point, the market takes a real pause, probably spends the next anywhere from 6 to 18 months past that time regrouping as well as selling off to see some significant profit taking.
Yeah, I suppose markets will be trying to find their feet and to navigate what's to come. So let's take a look at some of the potential event risks. Of course, you've got the new Trump administration coming online. You have the earnings season just around the corner. And the next FOMC meeting is happening sometime at the end of the month. What are you expecting in terms of some of these events?
All right. Well, Trump coming into presidency generally should be good for the market. It's certainly not by much at this point, but it is higher than election day from a couple months ago. So, the market has continued its bullish way. So in general, I think his policies and the way he approaches business is generally good for the market. So we'll give that kind of a plus column check mark. We've got a Fed who probably will do nothing in January. And I think they're kind of caught in a difficult place because they're still, in theory, looking to lower rates. But if you look at the U.S. 10-year, it's very clear that bond investors are not thinking that lower rates are coming. And much in alignment to how I'm thinking about the bigger picture of the bond market, I think it's pretty clear the 40-year bull market in bonds from 1980 to 2020 is done with. The minimum amount of time we spent beneath 4% this year in the U.S. 10-year, bottoming at 3.6 and then shooting higher by a full percentage point, makes me think that it's unlikely bonds would spend any, and when I say bonds, I'm talking about the U.S. 10-year, that it would spend any appreciable time now underneath 4%. And I've been telling my institutional clients that if rates back down from where they are now, but even get 25 to 40 basis points lower than where they are, I would probably be looking to reduce exposure to the bond market in general, because the long-term equilibrium price for the U.S. 10-year is well higher than it is now. And I can make the case that we'll see not just 5.32% at some point this year, but into next year or the year after, I can make the case that we get up to the high 6%, almost pushing to 7%. I don't think we get beyond there. But I don't think bonds are a good investment. And if we get a move like that in the bond market, Ryan, I can't see how stocks are going to keep moving up the way they have.
Yeah, I want to watch out for as we track 10-year bond yields at 7-month highs, lingering around 4.6%. We've been in conversation with Rick Bensignor. He's the president for InTheKnowTrader.com. Rick, always a pleasure having you on the show. Thanks so much for your time and insights.
Thank you, Ryan.
All right, stay at Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.